In the latest twist of economic events, Christopher Waller, a voting member of the Federal Open Market Committee, FOMC, has tempered expectations of an imminent rate cut. Waller emphasized that easing measures should only be implemented when the Federal Reserve is confident in the sustainability of lower consumer price index (CPI) levels. Across the Atlantic, inflation data in the United Kingdom and Canada surpassed expectations. While this might not immediately prompt additional rate hikes from the Bank of England (BOE) or the Bank of Canada (BOC), the unexpected surge in inflation challenges the narrative for multiple central bank cuts in the coming year. Australia threw a curveball into the mix with its December employment figures, revealing a surprising -64,500 job growth print, including a notable -106,600 in full-time positions. The critical question now lingers: is this an isolated blip, or does it mark the inception of a more profound trend? Regardless, signs indicate that the peak cycle may have already arrived. In response to these developments, yields experienced an upward trend over the week as the market re-evaluated expectations of swift rate cuts. Forecasts anticipate the European Central Bank, ECB, to implement a total of 75 basis points, BP, in rate cuts in 2024, with the Federal Reserve expected to make a 100 BP reduction. Despite around 130–140 BP of cumulative cuts already factored in for both central banks, there remains a prevailing view of additional upside risks to pricing moving forward. On the Asian front, China marginally surpassed its 2023 growth target of 5%. However, analysts are quick to underscore the patchiness of the economic recovery, particularly amid the ongoing property crisis. Wall Street responded positively to the news, with indices and U.S. yields experiencing an upswing on Wednesday. The Nasdaq in particular reached a record high, fueled by the U.S. government's successful averted shutdown until March. Speculation surrounding China's state-backed pension funds entering the ETF space added an intriguing dimension to Wednesday's market activity, resulting in a late bid for Asia-Pacific stocks. Meanwhile, OPEC and the International Energy Agency, IEA, offered a positive outlook by upgrading their oil demand forecasts for 2025. In the aftermath of the U.S. headline inflation surpassing expectations 2 weeks ago, the upcoming focus shifts to the personal consumption expenditures, PCE, inflation measures. While the core PCE serves as the Federal Reserve's preferred gauge, its lower volatility means even a slight miss or beat could sway market sentiments. The steady decline of PCE inflation towards the Fed's 2% target. This development could potentially impact the US dollar, supporting Wall Street and potentially propelling the Nasdaq to a new record high. Conversely, a set of inflation numbers exceeding expectations could strengthen the US dollar and dampen risk appetite. Beyond inflation, the United States will eagerly await the release of preliminary GDP stats for Q4 on Thursday, with a forecasted annualized growth rate of 1.8%. However, the Atlanta Fed's GDP-NOW model, historically accurate, suggests a more robust growth of 2.4%, creating the possibility of a stronger-than-expected GDP print. If the model proves accurate, the dollar may benefit as traders reevaluate expectations of rapid-fire Fed rate cuts this year. Adding to the economic pulse, the core PCE price index for December, scheduled for release on Friday, could play a pivotal role in shaping expectations around Fed policies. As the week unfolds, the intricate dance between economic indicators, central bank actions, and market reactions will continue to influence the trajectory of the U.S. economy and global financial markets. The upcoming flash PMIs from S&P Global offer a forward glimpse into the lagging GDP figures. A key focus, particularly in the U.S., is whether next week's data points surpass expectations. If so, this might prompt further covering of dollar shorts as investors realize the Federal Reserve is not on the verge of loosening rates. Examining composite PMIs, there's an argument that they have already bottomed out and may trend higher in the coming months. This potential upswing in growth, coupled with its inflationary implications, adds resistance to aggressive dovish sentiments against central banks. The intricate dance between economic indicators and market reactions continues to shape expectations and influence currency dynamics, making the forthcoming week a crucial period for gauging the market's sentiment toward the US dollar and global economic prospects. In the euro area, all eyes turn to the European Central Bank, ECB decision on Thursday, with market expectations leaning towards the central bank maintaining the status quo. The focal point will be President Lagarde's commentary, as several ECB officials have sought to temper speculation about imminent rate cuts. Despite an 85% probability assigned by markets for an April rate cut, policymakers, including Lagarde, have cautioned that such a move might be premature, indicating a potential cut later in the summer. If the ECB emphasizes this message during the upcoming week, the euro may experience a brief spike as some rate cut expectations are unwound. However, sustaining any advances could prove challenging given the backdrop of sluggish economic growth and warnings of a potential technical recession from business surveys. Speaking of surveys, the next batch is scheduled for release on Wednesday, a day before the ECB decision. While recent comments from ECB members suggest limited excitement regarding hints of looser policy, some policymakers have joined the chorus in pushing back on immediate rate cuts. Lagarde's speech, while often more ambiguous than concrete, remains a potential source of market influence. If any hints of a hike before the summer were to slip, it could bolster the euro and weigh on the DAX. As uncertainties loom, the week ahead promises to be a crucial juncture for gauging the euro's resilience amid the complex economic landscape. With the NISR forecasting a 0.2% GDP growth in the first quarter of 2024, pound traders are turning their attention to the preliminary PMIs for January. This data will offer the first insights into how the UK economy is faring as it enters the new year. Beyond the headline figures, the employment and prices sub-indices will be closely scrutinized. These components could provide indications of whether the rebound in December inflation was solely driven by base effects and is likely to be temporary, or if inflation is persisting more than previously anticipated. Positive numbers reflecting improved economic activity compared to the second half of 2023, along with sub-indices suggesting sticky inflation, might reassure investors about the Bank of England's stance on delaying discussions about lower interest rates. This scenario could lead to a decreased probability of a rate cut in May, potentially causing the pound to strengthen further. Investors will be closely monitoring these indicators for a clearer picture of the UK's economic trajectory in the early months of 2024. In Canada, the central bank is set to announce its decision on Wednesday, generating anticipation with a 15% probability assigned to an immediate rate cut. The Canadian economic landscape has presented mixed signals recently, with robust wage growth and soaring housing prices due to record immigration, raising concerns about sustained inflation. Despite this, core inflation has witnessed a notable decline, dropping to 2.6% in annual terms in December. With the Bank of Canada, BOC, targeting inflation within a range of 1% to 3%, there's an argument that the mission is nearing completion. However, the latest business survey from the BOC has cautioned about a weaker demand outlook, potentially exerting downward pressure on inflation. Considering these factors, the central bank is likely to maintain interest rates at their current level during this meeting. However, a more dovish tone may emerge, subtly hinting at the possibility of an easing cycle later in the year. The nuanced balance between economic indicators and potential policy shifts underscores the complexity of navigating monetary decisions in the current economic landscape. Yen, the Bank of Japan, BOJ, known for infrequent policy changes, is facing growing expectations for a shift away from its ultra-dovish stance in the first half of 2024. However, recent economic data suggests little justification for such a move. Softening inflation rates and a modest 0.2% year-on-year increase in wages for November have left the BOJ searching for evidence of growing wage pressures to support abandoning negative interest rates. As the Japanese yen lost 5% of its value against the US dollar in the first 3 weeks of the year, investors have become convinced that the BOJ will postpone its plans to exit negative interest rates. Initial market expectations positioned the end of negative rates in April, but traders have now extended this timeline to July, dealing a significant blow to the yen. Anticipating the BOJ's upcoming meeting on Tuesday, Governor Ueda has emphasized a lack of urgency in raising rates. The economic data trend has further weakened since these comments, suggesting the BOJ will likely maintain a cautious stance. Media reports hint at a possible cut in inflation forecasts for the year, signaling reduced urgency to normalize policy and potentially keeping pressure on the yen. On the data front, inflation statistics for Tokyo are set to be released on Friday, providing additional insights into the economic landscape and potential influences on the BOJ's future decisions. Investors will be closely monitoring these developments to gauge the trajectory of Japan's monetary policy and its impact on the yen. In January, the standout narrative revolves around better-than-expected U.S. economic data, leading to an uptick in Treasury yields. From a recent low of 3.78% on December 27, U.S. 10-year yields have climbed to 4.16%, essentially bringing them back to early September levels. This shift suggests a growing market confidence in the likelihood of a soft landing for the U.S. economy. However, it also prompts a reassessment of the Federal Reserve's approach to policy normalization in such a scenario. The market had initially priced in up to 165 basis points, BPS, in easing for 2024, but this is now diminished to 131 BPs. Investors perceive increased patience from the Fed and fewer insurance cuts, particularly as U.S. equities achieve record highs. Examining the future trajectory, the probability of a quarter-point cut in March dropped below 50% for the first time this year, falling from over 100% in December. Looking ahead, the market anticipates 30 BPS in cuts for the May 1st meeting, 53 BPs for June 12th, and 74.6 BPs for July 31st. Expectations increased to 97 BPs for September and 114 BPs for November. In contrast, the Fed funds dot plot indicates 3 cuts for the entire year. Crucially, the potential for rate cuts remains dynamic and could be swiftly reintroduced. A weak PCE report or disappointing January non-farm payrolls could bring cuts back into consideration, aligning with the emphasis that Fed officials have placed on data dependency.